The April reading came in at 2.8%, below the 3.1% analysts had penciled in, and the underlying measures the Bank of Canada watches actually eased. On a normal session, that print would have pulled the curve lower, trimmed mortgage costs at the margin, and softened the loonie's defensive bid. Tuesday delivered the opposite. The Canadian dollar slid to a near 5-week low of 1.3773 against the US dollar. The 10-year touched 3.744%, its highest since May 2024, and the 5-year, the anchor of fixed-rate mortgages, climbed to its highest level in nearly 22 months before flattening. The S&P/TSX Composite drifted lower alongside U.S. equities. Equity desks read it as a yield-led risk-off, not a domestic story. The headline citation from CTV that gasoline pumps absorbed the Iran war shock framed the print as benign, and the Globe and Mail's confirmation that headline inflation rose to 2.8% on energy alone backed that reading. Royce Mendez at Desjardins called the data a relief, telling clients monetary policymakers can rest easier. Yet swap markets still priced 50 basis points of tightening for the year, only 4 basis points lower than before the release. The tension thread refuses to settle here. The domestic signal pointed one way, and the price of money pointed the other. The core of today's session is that Canadian long yields are no longer being set by Canadian inflation. Mendez spelled out the mechanism in writing. Over the past week, domestic yield moves have been dominated by spillovers from other jurisdictions, and the soft inflation print did not pull yields down in the 5-year space, because that space is being repriced abroad. The transmission channel is mechanical. When U.S. Treasury yields run on Fed hawkish repricing and Iran-driven oil at 108.65 a barrel, Canadian government paper has to clear at a similar spread, or it does not clear at all. That is why a 2.8% CPI and easing core measures produced a 5-week loonie low rather than a relief rally. The differential narrowed against Canada because the U.S. side widened, not because Ottawa surprised. Here's where the explanation stops being clean. The same Mendez note conceded his base case is for 5-year yields to come down, but admitted it is hard to have a lot of confidence in that view right now. The condition under which the domestic decoupling logic breaks is straightforward. If oil retraces from the Iran premium and the Fed steps back from a curb energy inflation posture, the spillover reverses and Canadian yields would catch the dovish CPI they just ignored. The decoupling is conditional on a war premium and a hawkish Fed staying in place at the same time. Remove either leg and the 5-year has to revisit the inflation print it skipped over. The unresolved piece from the paradox layer is that the 5-year, not the policy rate, sets the marginal cost of housing credit in Canada, and it is being priced by Washington and Tehran. That is the channel where today's session writes its bill. A 22-month high on the 5-year feeds directly into fixed-rate mortgage resets through 2026 and 2027, exactly the window in which Prime Minister Mark Carney's government is staking growth on capital-heavy projects. The $14 billion Bay du Nord deep-water sanction announced the same day, Agnico Eagle's $2.4 billion Hope Bay greenlight, the $1.5 billion Nouveau Monde Graphite mine fast-tracked through the Major Projects Office. Each of those is a domestic capital story whose financing math assumed yields would drift, not surge. The historical parallel is 2022, when global yield spillovers ran ahead of the Bank of Canada and forced a tightening cycle the domestic data alone did not justify. The bank had to follow the curve rather than lead it. Two conditions decide which way this resolves. The continuation case, 5-year yields stay bid above 3.40% into the next CPI release on June 24, and the loonie holds below 1.38, confirms that Ottawa's softer domestic print has lost its grip on the long end, and Carney's project pipeline absorbs a higher cost of capital before a single shovel returns capex. The breakdown case, a Middle East ceasefire pulls oil under 95, and the Fed signals it is finished, sending the 5-year back below 3.20, restores the textbook reaction where 2.8% CPI buys lower mortgage rates. Mendez leans toward the breakdown, but only weakly. The verification benchmark 5-year Government of Canada yield close on June 24, the next CPI release date. The deeper question the session leaves on the table is whether a domestic central bank can still claim its own curve when the marginal bid sits offshore. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.